Hello again, folks. This is Richard Reyes, otherwise known as the Financial Quarterback and Investor Coach, and welcome to presentation Choosing Your Investment Philosophy. This is a part 2 of our investor education series, and together with our Separating Myths from Truth presentation forms the basis of our investment philosophy for our clients. Years of experience in the business has shown me that many investors find themselves trapped in this perplexing cycle of underperformance and missed expectations from their investments. And so we put together this presentation, Choosing Your Investment Philosophy, in order to show you what is the missing link that can offer long-term peace of mind. Have you ever worried about getting high enough returns on your investments, or maintaining your standard of living at retirement? How about affording a high quality education for your children? Have you ever worried about the next market crash, missing out on the latest, greatest stock tips? About making sense of all the information available, or someone else having a better portfolio than you? Have you ever worried about not having enough money to care for your loved ones, getting bad advice, and about worse yet, paying for it? Have you ever bought an investment when it was doing really well, when it was high, and later sold it because of bad performance at a low price? If you can answer yes to any of these questions, then you are definitely in the right place. Because investing is usually done in an effort to have money to accomplish life goals or realize dreams. Knowing that we have money for the future can offer us a pretty good sense of peace in the present. However, instead of bringing peace of mind, investment decisions are often very complex and confusing, leading to distress, worry, and anxiety. So this workshop is going to identify the dilemma that investors face. It will also help you integrate your true purpose of money with your market beliefs in your investment strategy. Most people don't realize that there are choices to be made regarding your market beliefs and investment strategy, and that there can be a drastic effect on your investment success if these choices are not discussed and addressed. So in this presentation, we're going to discuss how our market beliefs affect our personal investment philosophy and strategy. You will also have an opportunity to choose an investment philosophy in which you believe in, and I will explain how a well-defined investment philosophy can lead to lifelong peace of mind. Now, the investor has a dilemma, and this dilemma is a cycle that explains why many investment decisions are driven by emotional and psychological biases that may be inconsistent with an investor's long-term goals. On the other hand, investors want assets to grow to the point where enough wealth has been accumulated to meet personal financial goals. Yet for most, this will only happen by investing more prudently. Therefore, investors need to make decisions and select strategies to maximize investments year after year. Unfortunately, what happens is that the actions that investors frequently take are likely to be self-defeating. Let's look at how each step of this counterproductive cycle interferes with an investor's ability to develop and maintain a prudent investment strategy. So number one that we're going to take a look at is fear of the future. The cycle begins here. It begins with a sense of uncertainty about the future, characterized by questions like, will there be enough money to maintain my standard of living? How much money do I need to save? How do I know what's the best investments? And this is the feeling that the media and the advertisers prey upon in an effort to sell you more products. So number two is forecast and predict. So because of the fear of the future, investors have a strong desire to comprehend and predict the future. If someone could tell what is going to happen with inflation, long-term interest rates, share prices, overseas markets, there would be less fear of the future from an investment perspective. Along these lines, investors are frequently convinced that someone has the information, power, and insight to forecast the future. Now, the primary method investors employ to convince themselves that the future can be foretold is through track record investing. This means they look at stock managers or some guru who performed better than the market in the past with the hope that they will continue to have superior performance in the future. Which leads us to information overload, because in the past, gathering information was the best way to guide prudent investment decisions. However, the current information age has created access to so much information that it is easy to become overloaded. Investors feel compelled to understand all the information: the internet, books, newspapers, magazines, TV, talk shows, advertisements, friends, experiences, blah, 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 etc. Indeed, instead of reducing fears, what happens is that this deluge of information often intensifies doubts about investing. So as investors, we never overcome our own humanity. Even though most investors prefer to think that they make investment decisions based upon logic, typically emotions such as trust, loyalty, hope, greed, fear, these emotions drive our investment decisions. Now this leads us to breaking all the rules, because there are 3 commonly accepted rules of investing, especially in the market. You own equities, you diversify, and you rebalance. And the golden rule of investing is also buy when prices are low and sell when prices are high. Sounds simple, right? However, what happens is that investors make decisions based on emotions. They wind up breaking these seemingly simple rules, therefore sabotaging their portfolios. So this leads us to performance loss, which means investors fail to capture the returns they expected. Unfortunately, because investors so frequently break the golden rule of investing, they do not receive the rate of return they expected. So investor performance does not equal investment performance. When this effect is compounded over a period of years, an investor's potential for reaching financial goals is really significantly decreased. Such loss creates additional frustrations and fears about the future, once again initiating the cycle. And what's the result? Well, not enough money and no peace of mind. The end result is that the investor continues to maintain a worry, a frustration, and anxiety about the inability to accomplish meaningful life goals. So for most investors, the investor's dilemma remains undefined and continues over a lifetime. The first step forward, operating outside of this cycle, is becoming aware of it, and you have to already have done that. The next step is to choose an investment philosophy in which you believe. An investment philosophy is made up of 3 fundamental principles: the true purpose of money, your market belief, and your investment strategy. The first part of your investment philosophy is to develop a true purpose of money. This is a statement of the most important value that you want to express through the way that you use money. It is the thing that is more important to you than money itself. What fundamental value would drive both your investing decisions and your spending decisions going forward? The second is to develop a market belief by identifying what you believe about markets and how they work. And the third part is to develop an investment strategy, which is a plan to create and maintain your investment portfolio. When you combine these 3 principles, your true purpose of money, market belief, and investment strategy, you have outlined your personal investment philosophy. Now let's look at each one of these principles with a little more detail. Principle number 1 is true purpose of money. Your true purpose of money articulates the underlying values and priorities you want to address and the commitments that you wish to fulfill through the use of your money. Now, most people are comfortable talking about goals or specific achievements that they want to accomplish with their money. However, underlying these goals is a deeper and more meaningful value that drives these goals. Money itself does not bring happiness or peace of mind. One needs only to follow the lives of recent lottery winners to, bear this out. We all need a foundation. Now let me give you principle number 2, which is the second step in choosing your investment philosophy, which involves your beliefs about the market. Our beliefs, whether conscious or subconscious, are the root of the action. Now beliefs about the market and how it works are largely responsible for dictating decisions made regarding investments. Now, formed for many years and based on numerous factors, beliefs may be changed instantaneously based on new information or a new understanding. For this very reason, it is important to consciously examine your beliefs about the market. Now, there are two views about the market which are diametrically opposed to each other about how the market works and the nature of the markets. The efficient market or the market works belief system says that markets are random and unpredictable, and that they will quickly reflect new information and knowledge as it becomes available. Now, the market fails belief system states that markets react slowly enough to allow some individuals to analyze and predict the future in order to take advantage of mispricings and pass value onto other investors. Now, most investors don't even know or realize that there's a choice to be made about how the market works or what they believe. Without this knowledge, it's very easy to be manipulated by the media and advertisers. So the stock market, the media and popular culture, by and large, encourage a behavior consistent with the idea that markets fail. So in order for you to make your own decision, let's look at both sides of the story, and then we can figure it out more intelligently. Now, when we look at both of them, markets work and market fails, we're going to look at the questions of what does it mean, what's the story, and is there proof? So market works, and let's first examine what is called the efficient market belief. And what does this mean? Well, the name efficient market refers to the underlying premise of this view that the market, left to its own devices, is efficient. It's based on supply and demand. The free market is the best determinant of market prices. What this means is that all knowable and predictable information about future prices and movements is already factored into the current price. Therefore, only new and unknowable information and events change prices going forward. In this context, the randomness of the market makes it impossible for any individual or entity to consistently and predictably predict market movements and capture additional returns that are unrelated to risk. Markets are overvalued or underpriced. Markets that are overvalued and underpriced are not identifiable in advance. So what's the story? Well, in his book, Wealth of Nations, Adam Smith was the first to offer a comprehensive statement that markets work and that a free market is the best way for a social order to allocate resources. In 1994, F.A. Hayek, which won the Nobel Prize, went on to explain the power of the pricing system as a mechanism for communicating information. Fundamentally, the same principles apply to the theory of market efficiency as to the concept of capitalism, specifically that prices, incomes, and industrial production are determined by the workings of the free market system itself. So is there any proof? Well, the debate about the efficiency of the market has resulted in hundreds upon hundreds of empirical studies attempting to determine whether specific markets are in fact efficient. Many investors are surprised to learn that a tremendous amount of evidence supports the efficient market belief. Furthermore, academic research over the past 50 years in the field of economics just strongly, by far, supports the theory that markets work. And in 1990, Nobel Prize in Economics was awarded to Harry Markowitz, Merton Miller, and William Sharpe for their role in developing the concept of modern portfolio theory. And modern portfolio theory is a long-term investment strategy that includes diversification and asset allocation. So now let's take a look at the three questions concerning market fails. And let's look at the other story, or the other side of the fence. Okay, what does this mean? So when people believe that markets fail, the basis of this belief is that the market fails to price goods and services accurately. Because there are flaws in the system, it is possible for some individuals to identify in advance which prices are incorrect and in effect predict the future. Simply put, overvalued or undervalued price markets can be forecasted and predicted. By systematically finding misprices either in stocks or market sectors, it is possible, under this belief, to both increase returns and avoid losses in investments. So what's this story? Well, Wall Street was born in 1792, legitimizing the work of stock jobbers who had been doing business in taverns and over kitchen tables for years. This was speculation in the market, and the lottery was pervasive in the 1800s as it remains today. After the stock market crash in 1929, Graham and Dodd wrote in Security Analysis, often referred to as the stock picking Bible. So this book defined and justified the effort to analyze securities and find mispricings in the market and predict future winners and losers. Theoretically, the foundation of the market failure perspective correlates with the premise of socialism in the thinking that certain individuals intelligently designing and managing prices can do better than free market systems itself. Is there any proof? Well, empirical evidence supporting an inefficient market is poor. Statistical studies show that professional money managers who use speculative techniques designed to take advantage of misprices in the market are only able to provide higher returns than the market average at a level with what would be expected just by pure blind random luck. On the other hand, it is easier to find anecdotal evidence to support this view. Individuals who have beat the market are easily found in magazine covers and radio shows, TV talk shows, or internet chat rooms. There is an allure to this method of investing that is compelling to our basic instincts as human beings. So perhaps for the first time in your life, you know there's a choice to be made about the market, how markets really works, and you have examined both belief systems. Many investors live in a haze of confusion, never understanding that there is an unimportant choice to be made here. They are trapped in the investor's dilemma, trying to rationalize beliefs on both sides of the continuum. Now, while this may be comfortable and uncontested by media and advertisers anxious to sell products, it only leads to chaos for the investors. So if you want to escape the investor's dilemma, it is crucial that you take a stand regarding your market belief. This is where the rubber meets the road for the investor. In order to develop your own personal investment philosophy, you will need to choose between the belief systems of market efficiency or market failure. If you believe, as Adam Smith did, that free market sets prices better than any individual or group of people can, or do you believe that market fails and that there is an individual or group of individuals who best know what prices should be? What do you believe? What makes most sense to you? Now, the third part that we need for developing your investment philosophy is your investment strategy. There are two clearly defined strategies for investing, one associated with each of the specific market beliefs. The first strategy we will discuss is asset class investing, which employs an investment methodology that is consistent with the belief that markets work. The second strategy is speculative investing, otherwise known as active management. This approach is aligned with the belief that markets fail. So there are three tenets for each of these investment strategies. The asset class investment strategy is built on the tenets of market returns, asset allocation, and lifelong investing. On the other hand, the speculative investing strategy is based on stock selection, track record investing, and market timing. So let's examine each of these strategies in more detail. Asset class investing refers to a buy and hold approach to asset management. If you think markets work efficiently, then buying and selling securities in an attempt to outperform the market is effectively viewed as a game of chance rather than skill. Instead of trying to forecast the future, this approach involves applying scientific, academically proven strategies of modern portfolio theory. Three tenets of asset class investing are market returns. So we use structured or index type funds to deliver market returns for the asset classes in the portfolio. The other is asset allocation, which means that we expose the portfolio to multiple types of investments, including equities and fixed income instruments, domestic and international markets, and growth and value investments to provide maximum diversification and correlation effects. The goal is to maximize returns for a given level of risk. And the third is a lifelong of investing. This is a step beyond long-term investing, which is lifelong investing, and it's a lifelong process. Instead of attempting to get in and out of the market at the right time, staying in the market all of the time is fundamental part of success in asset class investing. So let's now examine the second, the markets fail strategy, which is speculative investing. So speculative investing or active management means that actively buying and selling securities with the assumptions that securities bought are worth more than the price paid, while securities sold are worth less than the selling price. So according to Webster's dictionary, speculation means buying and selling in the hope of taking advantage of an expected rise or fall in price. Active management is analogous to speculating in the market. There are three tenets of speculative investing, which are stock selection, which means that you pick stocks that will get high returns in the future and invest in them. This technique can be implemented in both individual stocks as well as within other investment vehicles such as mutual funds. There's also track record investing, which is what you utilize as an investor, and you use previous performance to determine whether or not to invest in the stock or the mutual fund for future. And then there's market timing, which is any attempt to alter or change a portfolio based on a prediction about the future. Now, these three tenets are the most commonly used and accepted tools of investing among retail investors and traditional financial planners. They are associated with terms, they are associated with the term investing and are portrayed extensively in all forms of media, magazines, books, internet news, radio commercials, banks, Wall Street, etc. But they are not truly investing. They are actually speculation. So to escape the investor's dilemma, it is critical to pick an investment strategy and align it with your market belief. When we have market beliefs that are inconsistent with our investment strategy, the result is confusion, anxiety, and maybe often despair. But when our investment strategy and our market beliefs lines up, then the result is internal confidence. We have a renewed sense of control and a lasting peace of mind. On our journey toward peace of mind, it's going to be crucial to align your investment strategy and your market belief once and for all. What is your investment strategy? It's time to examine your belief and your actions in order to determine if they are aligned, and then look at some options. Now let's take, for example, the boxes up here. So if your belief is that markets work, and you believe in asset class investing, then you would align your thinking with this. So when you think that markets reflect all knowable and predictable information and current prices, then the best approach is to diversify, allocate assets, and invest for a lifetime. There is no need to be concerned with short-term get-rich-quick schemes. You can disregard media hype and continuous stock market updates, knowing that with a buy and hold strategy, you will have the money you need to reach your goals. Now, the conflict here would be if you believe that it is possible to identify mispricings in advance, then utilizing diversification and asset allocation over the long term is inappropriate. Believing that markets fail to set prices accurately, it follows that you would want to stay connected to short-term market fluctuations and analyze information so that you can take advantage of the inefficiencies in the market, which leads to obviously despair and resentment, while aligning yourself with MarketWorks asset class investing aligns yourself with confidence and peace of mind. So which one do you think is better? So congratulations, you have done the work to discover true purpose of money and to examine your market belief and to identify your investment strategy. Now, putting them all together, you have developed your personal investment philosophy. So how can you use your investment philosophy in support of ongoing decisions and actions related to your investment portfolio? Well, many investors believe that free markets work, but find themselves investing in things and ways that support the market failure belief. Once this conflict is identified, they are able to bring their actions into alignment with their belief and get out of the investor's dilemma. Here is how you use your investment philosophy. If you believe that markets are efficient and you support the asset class investing strategy, then you should eliminate speculative investment techniques, which is stock selection, track record investing, and market timing. Also, we would eliminate active management, which subscribes to these investment techniques of stock selection, track record investing, and market timing. We would also work with a financial professional who believes markets work and offers asset class investing, provides education, discipline, and coaching. We would, of course, ignore media hype. We would set lifelong financial goals that help you to realize your true purpose for money. We would focus on capturing market returns, utilize asset class or structured funds. We would diversify prudently and identify your risk tolerance. If, however, you believe that markets fail and support speculative investing, active management, then your actions will be different. You should pursue speculative techniques to capture inefficiencies in the market. You work with a traditional financial planner who believes in and implements active management strategies. You stay connected to all sorts of financial information, therefore the internet, magazines, talk show, news, etc. You read every article about stocks and options that you can find or that are available. You continue to wonder and worry about what might happen next, and whatever you do, don't miss the next stock hot tip. Now, this part of the presentation is the 20 must-answer questions for the journey towards peace of mind. It's very important that you answer these questions, and this also gives you an opportunity to take action so that you can make a decision right now about taking a journey toward a peace of mind. So let me tell you what we need to do. The problem with the discussion is that many times it creates more questions than answers for investors. So many of the answers you need, you have to reach on your own. Now, like I said before, I'm going to give you these 20 questions that you must be able to answer if you want to someday achieve peace of mind about your investments. Now, the questions should be relatively easy, and they all have either a yes or no answer. The catch is that you have to answer 100% yes to each question, otherwise it is a no. So let's see what our answers to the questions will be. Okay, so question number 1. Have you discovered a true purpose of money, that which is more important than money itself? Yes or no? Like I've told you before, it's not enough to know that money is not the most important thing in life. In order to answer yes to this question, you have to be able to know for you what is the most important value that you hold. That which is more important than money itself, and that which is more important than everything else in life. Question number 2 is relatively simple, and most people can answer yes because through 401ks, IRAs, pensions plans, or personal investments, you can probably answer yes to this question, which is, are you invested in the market? Question number 3 is, do you know how markets really work? Folks, I talk to investors all the time. They have money in the market, but when it comes to understanding the underlying dynamics of how the markets work, they don't really know. It can be very disconcerting to have a portion of your wealth invested in a way that you don't really understand. Now, question number 4 is, have you defined your investment philosophy? Now, this is part of what we tried to accomplish in this presentation. Now, we all know that whether it's religion, education, science, or history, that philosophy is imperative to making solid decisions. Like I told you before, there are basically 2 investment philosophies. One is that markets work, and that through the process of supply and demand, the market sets a price that's impossible for any individual to consistently predict or forecast what's going to happen next. That is what I told you was free market. Like Adam Smith said, it sets the best possible price by taking all the plans and unknowable information and prices it into the pricing system today. That is the basic philosophy and foundation for the free enterprise system in America today. Now, there's another investment philosophy, and that is that markets fail. That markets consistently and predictably misprice things, and that there's one brilliant individual, guru, expert, financial planner, whatever, or brilliant committee that can tell you what the real price is, and that they can maximize the wealth to an economy or to an individual. That is the basic premise that was actually developed by Karl Marx, and the basic premise that socialism was built on. So now, once you're able to identify what your investment philosophy is, then you're able to design strategies that are going to be supportive of that philosophy. Most people end up strategizing before they really even understand what the basic philosophies are and which one they truly believe. So number 4 is, have you defined your investment philosophy? Number 5, have you identified your personal risk tolerance? Do you have an academic number, and have you thought about it and cognitively, consciously made a decision of how much and what type of risk you want in your portfolio? Or have you had more of a smorgasbord approach, where one year this investment looks good and another year that investment looked good, and over the years you've sort of just collected stuff haphazardly and built a portfolio in which you don't know what the risk is? Now, number 6 is, do you know how to measure diversification in your portfolio? Do you have a specific number that you can identify that tells how well or how poorly you're diversified? Now, question number 7, do you consistently and predictably achieve market returns? To be able to answer yes to this question means that you have to know historically over at least the last 60 years what market rates of return have actually been. These are the benchmarks that you want to look at as you build your portfolio going forward, because most people don't know historically what markets have done. They have no idea whether they consistently or can or have achieved market returns or dramatically underperformed the market. I can tell you, though, that statistically, that by far the vast majority of investors consistently and predictably underperform market rates of return. So question number 8, have you measured the total amount of commissions and costs in your portfolio? Many of those costs can be hidden and were talked about in detail in our presentation, Separating Myths from Truth, the True Story of Investing. Question number 9. Do you know where you fall in the Markowitz efficient frontier? Now let me explain what it is. Markowitz, as I told you before, won a Nobel Prize and determined that once you build a portfolio, you can actually identify how much volatility a portfolio has based on historic rates of returns. Then you can use modern statistics and analysis to create a portfolio that has a maximum expected return for any level of risk that you're willing to take. It's critical to know where you fall so that you can look at what rates of return you're getting for what risks you're actually taking. So question number 10 is, when it comes to building your investment portfolio, do you know exactly what you're doing and why? Now question number 11, are you working with a financial coach versus a financial planner? See, a financial coach focuses on helping you answer the 20 must-answer questions that we're talking about today and help you solve the chronic problems that commission-based brokers and commission-based financial planners create. Question number 12. Do you have a customized lifelong game plan to guide all of your investing and spending decisions? This is a way of looking at all the things that are available to you, all your life goals, all your assets, and actually planning out what you want to do with your life and with your money, so that when you come to the end, you can say that you lived a life without regret. Question number 3 is an often no. Do you have an investment policy statement? Now question number 14. Have you devised a clear-cut method for measuring the success or failure of your portfolio? Folks, what do you have? Where is your measurement tool to know if your portfolio is actually doing what it's supposed to do? Question number 15 is, do you fully understand the implications and applications of diversification in your portfolio and how to build them? Question number 16 is one that's very important to answer. Do you have a system to measure portfolio volatility, or what often is called risk? Now, question number 17, are you aware of the incentive brokerage firms in the financial community have when selling commission-based products? Let's face it, the large financial institutions have a vested interest to get investors to trade more than they should. That is the bottom line, and there's somewhat of an unholy alliance between the financial institutions and the large media outlets, a la TV, radio, press, whatever, to keep you gambling and speculating with your money. That's what sells ads on TV. That's what gets magazines placed. You'll also find built-in conflict of interest. The people that are buying the ads during the news programs are the same people who are talking as the experts on the program. If you're not gambling and speculating with your money, the brokerage firms are basically out of business. The financial news programs go off the air. There are people that make a lot of money promoting speculating and gambling with your hard-earned money. Now, question number 18 is, do you know the 3 warning signs, the 3 specific signs that you are gambling and speculating with your money? If you don't, go back to Separating Myths from Truth presentation, where we will talk about it in detail. It's very difficult for most people to know if they're speculating or if they're prudently investing, because what happens is that they have no way to distinguish between these 2 activities, especially when so much of the world leads you to believe that you're prudently investing, when in reality all you're doing is gambling with your money. So number 19, can you identify the cultural messages and personal mindsets about investing that destroy your peace of mind? So many of the mindsets and beliefs that we individually take on or take on about money are not things that we develop when we're 55 or 35 or even 15. Actually, many of the ideas and mindsets that we have developed about money come from our childhood, and maybe as young as when we were 5. So question number 20 is, are you ready to shift your personal experience of money and investing from a scarcity mode to an abundance mode? I find that people who are suffering from portfolio losses, the lack of diversification, the excess of cost, the commission bias built into the planning and brokerage process are continually in a state of scarcity. Not enough time, not enough money, not enough peace of mind, not enough clarity, focus, and capability to move forward into the future. And they are in a very diminished state. Now, this is the only question out of all 20 that you need to be able to answer yes to in order to start making progress. Are you ready to begin to shift your experience of your portfolio, of your money, from a scarcity mode to an abundance mode? And if you can answer yes to that, then you're ready to take the next step to create abundance in your life. So let's see how you scored. On the score chart, you can get 5 points for every question that you answered yes to. How many people answered yes to all the questions? Now, that's very impressive. If you did, you're an expert. You're an amazing investor. Congratulations. However, where I see that most people fall is in the 0 to 20. They fall under frustrated investor. They're flustered, they're confused, and you often wonder where to begin and find it impossible. However, here's the opportunity. I would like to offer you the opportunity to find out how these concepts apply to you. The best thing to do is to call me, Richard Reyes, at 407-622-6669, or you can email at me at richard@thefinancialqb.com, and we can get together and I can plot the information and take a look at your portfolio, at your plan, and begin to ask you a series of questions that you have probably never ever been asked before and never ever answered before, and begin you to start getting involved in the process. Because folks, this is not about product, this is about a process in order to reach a abundant life, in order to reach a full-fledged peace of mind in investing.